Good morning. I'd like to call the Investment Committee of the California State Teachers Retirement System February 7th meeting to order. Mr. Weech, would you take the roll, please?
Good morning, Mr. Chair. For the State Treasurer, Ms. Milliron. For the Director of Finance, Mr. Reyes.
Present.
Mr. Lawson.
Here.
Ms. Hendricks. Ms. Dillon. Mr. Rosensteel. For the State Superintendent of Public Instruction, Mr. Zeiger. For the State Controller, Mr. McGuire. Chairperson Keeler, you have a quorum.
Thank you. Just an announcement about the day itself relative to the agenda for the purpose of the public and planning for your day. There's an item entitled Board Education, which was scheduled for 2:30 this afternoon. That item is being pulled from our agenda because our general counsel, who is critical to that item, is unable to be with us today. So a board education item scheduled for 2:30 will not take place today. As a result, we'll be moving the compensation committee item, which is scheduled for 3:30. We'll be moving that up to the 2:30 slot. So compensation will be moving up to approximately 2:30. At the conclusion of the compensation item, we will move right into the board item, which is scheduled for 4:30. So essentially, everything is being moved up about an hour. The board will begin at 3:30 today. But please note that items number 6 and item number 9, which are listed as board items, will not be addressed today. Items 6 and 9 on the board agenda will not be addressed today. They'll be addressed tomorrow. So that is just some house cleaning and some planning for the day. What I'd like to do is also take at this time item number 9. I know we can do this more than once in the meeting, but if there are members of the public that are here today that have submitted their names to speak, we will take public comments at this time. Are there any public comments at this time? Okay, seeing none, we will then also check later in the day to see whether or not there are any public comments. With that, item number 1 is the approval of the committee agenda and work plan. I'd entertain a motion.
Move approval.
Second.
Moved by Dillon, seconded by Reyes for approval. All those in favor?
Aye.
Opposed? Item 2, approval of the minutes of January 9th, 2013, the investment committee. That is a consent item. And item 3, the home loan program, is also a that is also a consent item. Does anyone want to pull either item 2 or item 3 from consent? Seeing no polls, I'll entertain a motion to approve both items 2 and 3.
So moved. Second.
Moved by Dillon, seconded by Hendricks to approve items 2 and 3. All those in favor?
Aye.
Opposed? Okay, those items are moved. Okay, which brings us to item number 4. It's an information item, which is the continuation of the asset liability study, step number 4 in the process. And this is PCA, Alan Emkin, and Neil Rue, along with Chris Alman. Good morning, gentlemen.
Good morning. We will not go through every slide. Matter of fact, we will probably not go through most of the slides. And our goal today is really to give you our thinking and really do it in summary form to really help you frame the discussion. You've done an enormous amount of background and history, and the goal today is really to target the key policy considerations. And I just want to underscore with one thing. You retain us to have an opinion. You don't have to agree with our opinion. The key is, though, we do have an opinion, and we want to share with you why that opinion is what it is, but that's just for your consideration.
Okay, good morning, Investment Committee. Neil Rue from PCA, nice to be back. I'm just going to give a little quick recap, just to refresh everybody's memory of why we're here. Just to begin, we are recommending that CALSTRS reorganize your investments at the strategic level. We've been talking about this for 12 to 18 months, talking a lot about macro risk management, why that's important. And why we want to do this is right now you organize your investments at the strategic level, at the policy level, where you folks deal with allocating your investments by asset type. And we think, the reason we want you to reorganize is we think that the asset type framework is an impediment to the proliferation of investment, looking at the proliferation of investment options that are available to you as a system to invest in. So it slows you down. It's a friction to get you to allocate in an optimal manner. So that's one reason. The other reason is, and we've talked about this in looking at the riskiness of your plan, is that the asset class structure, where you think you might be diversified because you're investing in all these different asset types, it's misled you. And this goes back to looking at the red boxes and all those kind of things that we showed in many charts in the past. But it's misled, I don't want to say you, it's misled us over time in terms of how we're diversified. And in fact, instead of having great diversification across a bunch of different asset types, you actually have a risk concentration in one certain risk type. And that's an issue, and we want to be able to address that strategically. So those are the two real motivations for changing the allocation framework of your portfolio, and that's really what we're talking about. So we've had a lot of conversations with you all about this. In the last session, very thick slide deck with lots of numbers and lots of tests and analysis, and happy to go through those numbers in detail.
No, we're not happy to do that.
If so desired. But what the message was that if you take this risk class framework on, that it will be of benefit. It will be of economic benefit to the system. Now, we presented that to you and talked about it at the last meeting, and there were some questions. What are your assumptions? What about the upside versus looking at the downside? So that's what this slide deck does, is it answers those questions. And if you just go to slide, we'll just go to slide, I think it's INV 49. Let's see if I can find it in here.
Neil, give us just a minute to get there on our iPad.
Sure. This is what it looks like.
49, thank you.
Yep. This is a two-dimensional box chart. Basically, you had two major issues. What about your return assumptions? And what about looking at, when we're talking about major event risk that might occur in the portfolio? Yeah, you looked at the downside, but let's factor in the upside events. And so we can sort of create a 2x2 framework and look at how the different structures compete against each other. And that's what this presentation does along those dimensions. And what this says, when you see the term RCF in three of the four boxes, the majority of the time, the risk class framework still beats, for the sake of a better term, the asset class framework. With the exception, just to be candid and upfront and honest, with the exception of that lower right box, which means if you assume a very normative, pleasant, normal environment kind of, normal distribution kind of world, and you take into account the upsides, it's a mixed bag. And there really is, there's sometimes the risk class framework looks to be a better solution. Sometimes the asset class framework is performing fine, thank you. So now, is that surprising? That's actually pretty intuitive, because if you think about the normal bell curve versus reality, the normal bell curve assumes bigger upsides. It assumes smaller downsides than reality. And of course, if you're going to assume bigger fat tails, you're going to get better upside capture. So this all makes sense. But I think the point on this is we did the tests, and in the majority of the time, the risk class framework pays off or does better, but there is this one exception based on our assumptions. Now, what I want to do is flip you forward to INV 60. And we can go in, we're going to come back to some of these charts in a couple of minutes. But the important thing is on that, those questions revolved around assumptions and also about major event risk, okay? But not about the sort of the general characteristics that come out of these two frameworks. And the point is what are the general characteristics? And I want to highlight that. So this basically says on INV 60, we did the analysis, we looked at different assumptions, the key finding, the risk class framework outperformed the asset class framework in the majority of the tests. It always produced equivalent or superior returns in the asset class framework. And it always produced superior downside protection. And it always had lower total risk than the asset class framework. So really what we're talking about here, where the asset class framework and the risk class framework were sort of competing against each other, is really in that event risk kind of area. We want to talk about that a little bit. So any questions up to this point? That's sort of summary comments on the whole presentation deck.
Hold on, Neil. Ms. Hendricks?
Neil, it would be helpful for me. Can you remind us of the key questions that we left our last conversation with, so that as we walk through it, we can,
Sure.
can you just remind us of that? Because it'll
Yeah,
help
we can go
me have
back
a
to that.
framework
We can go
have
back
this
to INV
conversation.
49, that they're sort of summarized right there.
46.
No,
Slide 6.
maybe so. Yeah, that's good. Thanks, Chris. Yeah, there's a lot of stuff in here. So, yeah, so the analysis that we went through last month focused really on the journey and the danger of during a long horizon, what might happen over the short term, because if something happens in the short term, it could kill your system. A long-term horizon, a 10 or 20-year horizon is nice, but if you get a 2-year crushing period, sort of all bets are off. But the response was, okay, that's very nice. We had some conclusions on that. But we want to include, you're looking at the downside, maybe overemphasizing that too much. So please, can you look at what might happen in a short-term period on the upside? And that's correct. We didn't focus in on that, so we revised our presentation, and those numbers are now included. So that was one question that came up. The other question is, the way PCA and the best practices is not to these days is not to assume that returns behave in a symmetric, random, normal bell curve shape. They do not behave like that. But historically, that's where the practitioner community has come from, is using that normal bell curve shape as the model for doing work like this. And so originally, when we came to you last time and showed you all these analysis, we used what's called a non-normal distribution pattern, which reflects the reality of how investments have behaved over the last 40 years. Now, the investment committee said, that's nice, but please show us what this looks like if we just assume, what practitioners have utilized in the past, the normal way of doing things, no pun intended. So we did that. And those were the two major questions. And, in summary, does that change our conclusion? There's some nice pictures in here, and here's the work we did, but does that change our conclusions, our conviction about moving to the risk class framework? We as consultants, as Alan said, our opinion did not change. So, any more questions before we dive into some summary comments? Okay, so we're going to go on a little bit of a thought exercise, but this gets into this notion of the trade-off between those extreme events, right? That gets back to that table right here. Let's have a little. There is this mixed outcome. There is this you know, if you assume the world is distributed like a normal bell curve, and we do take in the upside versus the downside, then, you know, the conviction becomes a little, based on this analysis, the conviction becomes a little shaky. So let's explore this notion of upside versus downside a little bit. And with the investment committee's permission, I want to have you folks, I think, let's see where I start. It's INV 18 for you. So what we're going to do is we're going to walk through an upside versus downside kind of scenario here. And we're going to start with a question. I'm going to say, this.
Sorry, Neil, it's INV
53.
Oh, I'm sorry, 53.
Slide 18.
It's okay.
This gets into a paper that's probably just as important as Markowitz's paper. It's written by a couple of people called Kahneman and Tversky. Have you ever heard of them? This was written in 1979, and it's a theory called prospect theory. And we're going to get into that a little bit, but here's the question. If you're offered a 7% return, it's the same 7% return that's certain, versus a 7% return, an expected return that's 7%, but it's uncertain, which one are you going to take? Now, it's just an interesting question. And what we're going to use as the uncertain proxy for this is we're going to look back to 1900, more than a century, and we're going to just say we have a stock and bond portfolio. What did that portfolio do? Well, coincidentally, it produced a return in the ballpark of 7 over that entire 100-year history. It had extreme events. On the upside, the 10% best events produced an average of 28% returns. And on the downside, the worst 10% of those outcomes, the average return was a negative 14. And the 7 is right in smack in the middle of negative 14 and 28. An interesting thing for me, and I didn't know what these, I've never done this before. I did this analysis for you folks, and I was sort of curious as to how this is going to spill out. But what's interesting is you can see that the absolute value of the gain is twice the size of the absolute value of the loss, right? So, that looks pretty good in terms of the upside kind of favor. So let's just take this information and say, this is gonna be our forward-looking uncertain outcome, is that we're gonna have a 10% chance of getting a 28, we're gonna have an 80% chance of getting a 7, and we're gonna have a 10% chance of getting a negative 14. It's what history has given us. Let's just roll with it and see what happens. So that's what we're gonna do. So here are our options. And this is like, if I come to you and I say, maybe I'm not the best counterparty in the world. If the US government comes to you and says, I'm gonna give, I'd like to give CALSTRS $150 billion worth of a 7%, or do you wanna take the uncertain 7%? Which one would you take? So here's based on this, we're gonna roll this out for 4 years to see what happens. Now, I don't know if you've seen charts like this, and I can't remember the exact name of these, but these just sort of show, based on those three-pronged outcomes, what are the final possible results, all of the results. So you start with $100, or you could multiply it times $1 billion, and it could be $100 billion, and you have 3 possible outcomes, right? The plus 28, the 7, and the minus 14. And then the next column over, you assign probabilities to those. You have a 10% chance of getting the 28, you got an 80% chance of getting the 7, and then you get a 10% chance of the negative 14. How much money do you end up with? Well, if you take $100 and you get the 28, you get $128, right? And you play those scenarios out, and then you start again. And you end up, since you have a 3-pronged thing, now you have 3 new starting points at year 2, and then you do those 3 prongs again. And then you have your outcomes over there on the end. Now, it's interesting, and this is the reason this paper was written, and it's a pretty big, important paper, is that notice down on the bottom where I have the red circle is the number, the expectation for each of these is the same. They both have an expected value, expected utility of $114, right? The top one, which is uncertain, those are all probability weighted outcomes, you get $114. Does that make sense? On the certain outcome, you're guaranteed to get the 114. So, they both have that, they're both going to, sort of give you the same initial expected result from the starting blocks that you stand in. But let's just start looking at this. So what do we got here? We've got, if you take the uncertain portfolio, you have an 81% chance of getting 7 or better. Pretty good. I mean, 80% chance of 7 or better. But you have about a 1 in 5 chance of not getting the 7. Okay? That's just what's offered up to you if you take that blue scenario. Conversely, you always get 7% if you take the certain. Now, the key here is that you're sort of playing the tails on that top one, right? That's why you take the uncertain one, because there's a tail involved, and there's an 80% chance that maybe you'll do better than the 7%. Okay, well,
7%
or better.
Not that you're going to do better than 7%.
Yeah. Okay, that's fair.
Let's be clear about that.
Yes. Okay.
Before you continue, Mr. Reyes?
Yeah, you say that you have 1 in 5 of not hitting the 7%, but you also have 1 in 10 of doing better.
Sure.
You have 1 in 10. So to say 1 in 5 is sort of, does not lay out the full picture, because 1 in 10 that you could do better. And just to clarify that, you have the up and the downside, and I get the 4 and 5 of getting the 7, but to say 1 in 5 of not hitting it, well, yeah, you could do much better. So just to clarify, thank you.
Yes. Yep. Okay. But again, I mean, you're right. There's a little bit of a focus on the downside.
I think that was a complaint last time.
Well, I mean, the way,
Paul, you want to weigh in if you want to? Thanks.
I mean, the way you
Mr. Rosensteel?
Thank you. The way you describe it, I mean, there's a 19% chance you do better than 7%. There's a 19% chance you do worse than 7%. And then there's a 64% chance that you get 7%.
Well, I think.
It's symmetrical.
Well, I think if you just add them up, you get 9. It's more than 10% of getting more than your objective.
Right.
So it's an 81% chance of 7% or better.
Or better. But
Yeah.
what I'm saying is, there's also an 81% chance of 7 or less. I mean, in other words, there's a.
No, there's a 19% chance of 7 or less. Well, I'm sorry, of less than 7.
You have a
Yes.
64% chance of getting 7, right?
Correct.
And then you have 36% of outcomes that are not 7%.
That's right.
And half of those, 18%, are higher, and half of those, 18%, are lower.
Correct.
So you have an 18% chance of getting higher than 7, a 64% chance of getting 7, and an 18% chance of getting lower than 7. That's just adding up those numbers under the year 2 column. So it's symmetrical.
Well, if you add the probabilities, I mean, maybe we're all
Yeah,
reading
it's
this
1
the same
plus
way.
8 plus 1 plus 8. And then below, it's
Yeah.
8 plus 1 plus 8 plus 1.
Yeah.
They both equal 18%.
Yes.
So you have an 18%.
Well, actually, look at the top scenario, though, Paul. Is you have up there, you can finish with 110 on the upper scenario, plus, so it's 19%, it's not 18.
Okay.
Okay? And it goes the other way, too. So we're playing the probabilities here. It's bigger than you think. Okay?
Okay.
It's
so
not
that-
18, it's 19.
It's 19.
Yes.
19 that you.
And that's where the 1 in 5 comes
that you
from.
do worse, and 17 that you do better.
Yes.
Yeah.
Okay.
So, but the basic point is, just taking the numbers, it's ballpark about a 1 in 5 chance of not making your objective. That's what it says. Okay, so and that, I would say, in this context of pension planning, just personal opinion, that's pretty big odds. I mean, do you want to play that kind of odds? But what happens if you miss? So what happens if you do go down that path? Well, the average outcome, if you do miss of that 19%, you're going to get 93. You're going to go from 114 and you go to 93. Okay, so that's your new starting point for years 3 and 4 now. That's where you end up after year 2. So now you have $93 instead of 100. And, oh, by the way, instead of 114, which is where you would have been under a certain environment, now the question is can you ever get back to your objective? And notice that the objective is rolling forward at its certain 7 on the bottom. And by the end of year 4, you need to be at $131. That was the certainty. Well, under this scenario, you only have a 1% chance. If you miss, you will virtually have almost no possibility of ever reaching your objective again that you were offered originally under the uncertain 7. So from my,
But in pension finance, the compensating balance is you increase contributions. And it's just important to put that in context because the pension plan can only grow and meet its liabilities from 2 sources. So if one doesn't deliver, the other one has to. Otherwise, you fail to meet the promises.
yeah, and in context of STRS, I mean, you're going through this negotiation right now, I believe, and you're going back to the state to negotiate your contributions, and the question is, and I think it's been, I'm no expert on this, but a dynamic has been that the state has never provided you with your actuarial required, or it's been a long time since the state has provided you with your ARC.
10 years.
Yeah, and so
You know, that's above our pay grade.
it's above our pay grade, but Alan's point's well taken. So now to be fair to the upside side of the coin is what happens if we hit. So if we hit and we actually do get, the 7 or above, well, the range, the place you'll end up is likely around 120, not 114, so you'll do better. And you end up at about 120. So you're ahead of your goal, after year 2. So the interesting thing is, now let's play this out over years 3 and 4, and that's what this slide up here shows. And that is on INV 56. What's interesting is you do end up with ahead of your goal. Instead of $131, you end up with 137. But notice that the odds of you falling below your objective, again, for a few years going forward, is still the same, even though you outperform. So it changes a little bit, but it's still about a 1 in 5 chance that the next time you're going to fall through, you're going to fall through. And again, if you fall through on that 20% node, 99% chance you won't be able to get back. So the point is on the upsides, does the upside really give you all that much benefit? And the answer is, and this is an interesting lesson. I mean, going through this is very interesting. The answer is it doesn't give you as much as you think. It really doesn't. And what's interesting is that oftentimes we end up at that place of 120 versus the objective of 114, and we might think we have money to play with of $6, but our odds really haven't changed of failure, have not changed, and we have to be careful about that. That's pretty darn interesting. So the summary points on this are, so just going back and thinking about that is which one would I take? I would probably take the certain 7. If somebody gives me a certain 7, I'd rather end up with a for sure 131 than to play the game with that uncertain outcome. Because I know I can get my 7. That's my objective. So that's what the charts told me. Now, in summary, what does that mean? That means if the return objective can be maintained, then trying to manage those tails as best we can is a good idea. Because downside outcomes, if they come, their 1 in 5 situation happens, it's going to blow your business model out. And why do we want to do that? And the point of the whole exercise is that in managing that tail risk better, and this goes back to the point I made before about the risk class framework, remember that all the things that we looked at, the expected return of the risk class framework was the same or better, the expected long-term return was the same or better than the asset class framework offered. What we were doing was managing the tails, trying to slice the tails away and get the return distribution narrower or more closer to that more certain outcome as best as we can at the margin. And so that's why, that's one big reason why we believe moving to a risk class framework is really critical and important. Just a couple more points, as we mentioned before, to go down this path, one of the risks that's not in the numbers is, although this would be implemented over time and deliberately and very carefully, we're not, this isn't a change that's going to occur in 6 months. Now your portfolio looks radically different. It's something that we would roll out over time, and it really is going to be a function of of further steps in the asset liability study. But nonetheless, it puts you on a new journey, and your investment allocation is going to eventually look very different particularly from your American peer funds. They're not doing this right now. So that's a maverick risk that would have to be accepted.
But that is not going to happen quickly, and at any point in the process, you could reevaluate and say that was a road that we shouldn't have taken, or we shouldn't go at the speed we're going. The key here is, from a consultant's perspective, is to focus on something we haven't really focused on before, and that's what happens in really bad events. And that the cost of those really bad events is disproportionate to the upside that you would get by assuming more risk in the portfolio. Because for those of you who are on the board 5 years ago and can remember 2008 and 2009, you're still just at the asset level where you were then, slightly above, but your liabilities continued to grow over that 5-year period, which effectively means your financial condition of the plan is deteriorated.
Well, and to Alan's point, going back to these numbers,
Neil?
yeah,
Member who has a question, I'd like to get to
Sure.
him. Also, I'd like to do a time check as well, so in terms of your presentation,
Almost
perhaps
done.
we can have Mr. Lawson ask his question. Alan and Neil, you can then finish up, conclude your presentation, then we can go to comments and questions from the full committee.
Okay.
And Paul, I see that you jumped in. Do you want to,
No,
is this going to be on
let
point?
them finish.
Okay, thanks. So let me go to Mr. Lawson.
To the point that you were just making about our portfolio looking different than the portfolio of other peer pension plans or other investment funds, as I understand what you're proposing, it would require almost constant analysis of what various of how various asset classes act in a particular environment. So the fact is that if I'm understanding what you're proposing, we're not sure you can't predict what asset classes are going to be in the mix, because what you're saying now is that what we thought the asset classes would do in a particular environment, where history has shown that they don't act that way. So we need to review them again to actually do a better job of predicting how they would act in a particular environment. But you're also saying that your predictions as of today are not necessarily going to hold true in the future, and that makes sense to me. So I guess one of the things that I'd like you to talk about, and not necessarily right now, is what you think, how often will that reevaluation have to occur? Alan has talked about how this is not going to change overnight. It's going to take time to move this along. How often do we need to reevaluate this? How quickly would we need to change in order to take advantage of a changed model with respect to a particular asset class, et cetera, et cetera? It just seems to me that we're embarking on a road that I think makes sense, but requires a lot more real-time analysis. And part of the question really goes to that timeline over which you're making your analysis of the projected response, the projected activity of these, or projected responses of these particular asset classes. I think that was a question.
Yes.
It was, I think so too. I'm not sure. But I have an answer no matter what. I'm good at that.
The question was, does what I said make sense?
The answer is yes, and that's truly either the next or even the next after that step in the planning process. But will the portfolio have to be more proactive? The answer is yes, and that is, and I'm just going to give you a very vivid example, at least in my mind. 25 years ago, buying a 15% Treasury bond really retrospectively looked very, very attractive. Believe it or not, there weren't lines of people to buy those at the time. But buying a 2% 10-year Treasury bond in a 3% inflationary environment is almost counterintuitive. Yet a static looking at the world would mean you would automatically invest in that 10-year Treasury, using that just as an example. And that might not be the right thing to do. At the very least, there should be a discussion on whether or not that makes sense to help fund a pension plan that's got a 50-year time horizon.
So I'm anticipating more discussion on that end.
Absolutely.
That's all it is.
Well, I think what we're really advocating right now is you're going to enter into, deeper into the asset liability study. And you're going to have to figure out you're going to have these different risks that you're going to confront that are plan-wide, not portfolio-wide. And you're going to have to pick the appropriate portfolio to address those risks. What we're asking for right now is that you allow us to use a risk class framework to do that, to see how the allocations spill out rather than asset classes. So once the conclusion is arrived at, then the implementation phase will come about where many of your concerns will be addressed or need to be addressed.
But you never give up the right to say, we don't want to go down that road. You could end up with a solution using this process that doesn't feel comfortable, and you could say, we want to look at something else, and that's completely your prerogative, and we would encourage you to do that if you weren't comfortable.
Well, I guess part of my question is, how often are you going to re-examine this, and how quickly, or, do you anticipate one particular asset class changing its risk profile so that we have to, if we follow this to the letter, we have to make changes to reflect that?
The key is, effectively, you would be making a macro decision. Those day-to-day decisions would be delegated to the staff. You would not be seeing it on a regular basis.
I understand that, but I'm
He wants
talking
to
about
know how.
I'm talking about the macro
often.
decision.
Yeah.
Every 2 or 3 years, just normal process, absent an event. And that is, if something dramatic happened somehow tomorrow, you could get 8% in the Treasury market, the world will have changed, and it's important to bring that to your attention and ask for some guidance.
Let me ask you a little bit differently. How often do you expect the risk profile of these various asset classes to change such that we would need to make a change in the macro decision-making?
I think those would barely be monitored at least on a monthly basis, if not. Yeah.
How often do you expect them to change? Looking at the history, looking at this 40-year history, and knowing what you're saying is, 40 years ago, these assets acted in this fashion, now they don't.
Right.
Over what time frame did those changes occur? And understanding that past is not prologue, but it can be used as a guide. What would you expect?
For some classes, there wouldn't be any change at all. For other classes, maybe at most annually.
I'm sorry, say?
At most annually. That maybe the classes need to be revised. If they need to be revised, probably annually. Okay. And revisions might not be that material, but they might be revised. So, and some classes will always maintain their appropriate risk exposures and will not have to be revised materially.
So this board, there would be an expectation that this board would be looking at macro level decisions almost annually.
Yes.
Okay.
Can I throw out an example, and I may be wrong? Real estate. At times, real estate is very driven by interest rates. Other times, mostly, it's driven by employment and the economy. But you think back to the 80s, 90s, and on, there have been just brief periods where real estate was very much influenced by a different factor. And I think that's what Neil's hitting at. We'd back up and say, we want real estate because we think it's a hedge against interest rates, but it's more sensitive. So we have to decide if we want to, it's not, that class isn't doing what we expected. I don't think, Neil, like equities, some of the big asset classes really have changed in that entire period.
And in our formal presentation, we're done. So Mr. Chairman, it's Q&A.
Thank you. Mr. Lawson, was there anything else? Mr. Rosensteel?
Thank you. I thought this discussion about what happens over 4 years was the most useful in everything we've talked about. And I think we have two very different questions here that we keep getting confused with each other. And I think that's one of the reasons there's a lot of confusion on this board. There's one question, which is what kind of risk do we want to take? When we look at that 4-year demonstration, does that convince us that we want more certainty even if we give up yield? I have no idea what the rest of this board thinks. We had a little bit of a discussion at the last meeting where there were some people who said that they didn't want to forego big upside if we were going to forego it, and others were going to see that big upside. So we have that policy question is completely, absolutely, entirely separate from whether we do an asset-based or a risk-based asset allocation. And we're getting the two confused. And so what we need to do is we need to figure out what this board wants to get to. My personal feeling is that I think I'm convinced by that 4-year demonstration, and I've run my own numbers and just the whole idea that if you get 0% 2 years, you're at 0. If you get 10% the first year and minus 10% the next year, after 2 years, you have less than 0 return. So I think we need to decide what we want as a board, and do we want less downside risk? And are we willing to do that even if that means we give up upside potential? And make that determination in the context of a very important point that Alan made, which is that we don't control the contributions, that the other side of an unfunding problem, a problem of being unfunded, is you make greater contributions. But this board can't make greater contributions because we don't have that power. So does that mean that our responsibility in terms of investment strategy should be to minimize the need for those additional contributions since we can't make them happen? My feeling is we should take that issue and we should resolve that issue, we should decide that issue, and then we should say, okay, now we know where we want to go, how do we get there? And then maybe this risk-based approach helps us get there better than a traditional asset allocation model. To date, I'm not convinced. I appreciate all the work you've done. I think there's been a tremendous amount of insight that I've gained. The world doesn't behave according to a normal curve. Assets are not uncorrelated the way we thought they were. But I'm not convinced that we improve things with a model that, if I can find the page, that if you look at INV 63, a model based on 14 risk variables, up to 10 years of prior history is utilized. 14 risk variables is a lot of risk variables. That's a pretty complicated model. 10 years of history is not very much history. Qualitative judgment applied. It's not giving me the warm and fuzzies that it works, and I understand the objective. I understand the concept makes some sense. I understand that the traditional model has its limitations. But just, I think, along the lines of some of the questions Michael was asking, it seems like an awful big change to make with a lot of consequences, with really no good theoretical but no proven basis. That's my opinion. That's where I am right now. If this board is being asked for direction, my direction is that I'm not ready to say go in that direction. But more important, my feeling is we should back up and we should talk about what the risk profile of this board is, because that's the really important thing.
I think this is right on point. But the challenge is that the output of the next stage in the process quantifies exactly that. And it shows you what the cost of assuming more risk is in terms of funding levels, contributions, et cetera. And it literally integrates the expected returns of the variety of portfolios with the liability stream coming out of the actuarial side. So you can not just say we want to have less risk, but less risk gives us these financial results. And that's truly the next stage in the process. And some of the board members have been through that in the past. You haven't, so it's impossible for you to know that.
When you say the next step in the process, you're talking about the April meeting?
Yeah, where we would integrate the assets and liabilities.
And that would address
You would
the,
introduce them at the April, sorry.
And in fact,
and
you
would
know,
that process address the issue of, that Mr. Rosensteel is asking, is how do we get to the issue of what is the risk profile, what are the risks, what is the risk profile of this committee, essentially?
What kind of risk do you have?
And so does that April item address the question that Mr.
it
Rosensteel
addresses it directly, because what we would be doing is asking the board to give us direction on what should drive the process. And in fact, if one of those is managing downside risk, it would solve for portfolios that manage downside risk. And unfortunately, and this is not in any way a criticism, we can't get beyond this new way of looking at things. And in fact, it's important on some levels, but dealing with your big issue, it's almost noise, because we can run it the traditional way. And that will give you a result that's not as robust as looking at a different way. But the key is to move the process. And whatever it takes to move the process, that's really important.
Chris, did you want to add? Did you want to? Okay. All right, thank you. Paul, you,
Yeah,
Okay.
I'm not quite sure I understood what you just said,
Well,
Alan. I mean,
what we need to do, and I think this is our fault, we should have done this. We should give you an example of the tools that we use to help you decide on what portfolio is the right portfolio. This is just how to model the asset side.
no, that's what I'm trying to say. I mean, that's why I think they're two different issues. One is a very technical one of which is the model that works better. And we know that the traditional one doesn't work very well. We have history with that. That's not debate. That's not open for debate, really. I think we all agree on that. The question is, does this other model do a better job? Is there any evidence that this other model does a better job? Or is it really just theoretical based on a little bit of past history? And that's, that's an important question for us to ask. But it does seem to me that the issue is what is the objective that we're trying to get to? And then the model we use is just the tool, whichever tool we use to get there. But I mean, we need to know what house we're building, and then we can pick up the right hammer.
So my suggestion, with your permission, Mr. Chairman, is at the next meeting, we'll literally pose those questions, because you'll get to weight them. Which is more important to this board? Exactly frame the way you've stated it. And then that's what you solve for. And that allows you to have a policy debate on what kind of risks you're willing to look at in the investment portfolio. And once you've given us that direction, either model will give you results that are not going to be dramatically, in my opinion, inconsistent. If the goal is to have less risk, either model will solve for more diversification. And the difference between the two models is one provides better diversification, but there's a certain amount of willingness to accept academic work as opposed to having 30 years worth of history.
And that's all I want is us to understand that we're making two different decisions. We're making one decision about what our objective is. We're making a different decision about which model we use to help us get there. And they're discrete decisions.
That's correct. And one last point, Mr. Chair, and that is, for 30 years, this industry looked at this exercise and quarterly performance reports based on relative returns. How are we doing relative to benchmark? How are we doing relative to our peers? That has nothing to do with funding a pension plan. You fund a pension plan with absolute returns. And that's a discussion that you need to have, because right now the portfolio is not designed around absolute returns. It's designed around relative returns, and that's one of the issues that we would address in the next phase.
Thank you. Anything else?
Thank you.
Mr. Zeiger?
I had a question last time, and I want to repeat it this time. It's not really to Alan, it's to the staff, which is the friction cost of what's the cost of the shift? And I mean, certainly in dollars, but also in the friction to the organization of moving from the way we're structured now to the way we would have to be structured to do this.
I apologize, we didn't walk down from a cost perspective. As we've discussed with PCA, it would probably take us 5 to 8 years to implement that. I don't know that the cost would be that great. It would be a different culture. The best word picture I can give you is that right now you have a director who's in charge of an asset class and a bunch of portfolio managers. Under this model, those portfolio managers kind of become their own units. And so we don't know how that looks. There's nobody we can point to say that we follow that. Compensation structure would need to be changed that way. I think we have the asset allocation committees and the risk team. Stephen would need more people on the risk side, but we kind of have the foundations of that in place. From a asset management side, most of the strategies are higher cost, but they're assuming a net return. It certainly would absolutely dominate the next 5 to 8 years. It would be the key focus is implementing this and shifting. We'd have to change a lot of our policies. We have policies driven by asset class. They would be divided up to the sub-asset class level. So it's not like it's earth-shaking. It's just change. I think we're structured. We could easily get there. Just take a little work.
So, and you know, in Paul's comments, I know what I want. I want us to outperform the market by 2% every year. Right? I mean, let's be real blunt about that. That's what we need to do somehow to make everybody happy all the time. Right? I mean, that makes everybody happy with us, and that makes us happy, and we don't get to pick that. So, you know, I mean, you can't in the abstract, I guess. We'll issue directions to staff, always outperform the market by 2% every year. It's just like, the question is, how can you get a better chance of doing that? Because if we miss on the upside, the risks to us are almost as great as if we miss, almost as great in some ways as if we miss on the downside. We take a political pounding either way whenever we're not slightly above the market. So, you know, I can't tell whether this is going to do that for us. It seems to me fairly clear that it may help in the down market. On the other hand, the risk is really high. If the stock market's taken off and we're not making any money, enough money, then that's as big a risk in the broad sense to the organization as in some ways politically as the other. You can argue that one of the reasons we're in the pickle we're in is because we did outperform the market for a while, and the upside was so big that everybody thought things would roll like that forever. So it's really hard to decide. And half of me wants to say, let's take the portfolio and split it in half. Manage half of it this way and half of it that way, and run our own little experiment. I mean, we're big enough that we could actually literally do that to see what would happen over a period of time. And that's one of the reasons I ask about the friction costs.
Okay. In fact,
Yeah.
In fact, that's what's going to happen. It's not going to be 50-50, but only a small component will be managed in a new manner, and you'll be able to compare the two. But what I really want to underscore is you said we just need to beat the market by 2%. In 2008, beating the market by 2% wouldn't have made you very happy, because you would have still been down by 24%. And that becomes the challenge if you're a pension plan.
Thank you, Mr. Emkin. One more member of the committee. Question, Ms. Hendrick?
So I appreciate our board and our staff and our consultants because I think this conversation is critical. And I think for me, hearing Paul and Richard comments, our job is to make sure teachers have a secure retirement and that this fund is here long after all of us are dust. And I think that, sorry, but it's true. I mean, we are long-term investors. I want teachers who come after me to have a secure retirement. And so I think this conversation we're having about risk is really serious and really important. And I think anyone who just says we can just beat the market, I get skeptical when I hear those comments because I think that, I think in the reality, what we want to do is make sure that we have money in our system to pay teachers and to do that with them having trust and security in our ability to do that. I think that, I don't know if I totally agree with you, Paul, that those are two unrelated questions, but it's clear that I think in our next meeting, we need to have the conversation around, what kind of risk we want to take. And maybe we've kind of done a little cart before the horse a little bit. And I think we should go back to that question of what kind of risk do we as a board want to take, and then sort of move forward and look at this risk model and say, is this the model that's going to take us there? I certainly think this board member feels like there's certainly it's a new economic world out there, and I think we need to be looking and thinking about things in a different way. And so I'm receptive to this conversation and this idea, and I think we should it would be helpful for us to just dialogue more about this question about risk for us as a board, our risk tolerance, and then continue the conversation.
So, thank you, Ms. Hendricks. Does anyone else want to weigh in? So as I understand the next step in the process, at the April meeting, we'll be going through an exercise that will help us determine essentially what the risk appetite of this committee is. And if that's then the case, from that outcome, to use Paul's analogy, that will then help us decide, how to build the house, essentially. So there's the question of what's the risk appetite of the board. Once we have an understanding of that, that will then determine what those assets will be allocated, and in what buckets, and whether or not it will be the risk framework or the traditional framework. So the April meeting is really, is that accurate? Would that be the next step in the process?
I don't know if that gets totally resolved in the April meeting.
But that we will get a clearer understanding through the exercise at the April meeting of the question of where are we relative to what types of risk we want to take.
The issue that Mr. Rosenstiel raised will be directly addressed. And the trade-off that Mr. Zeiger raised will be directly addressed, because you can't have both. There's no love without heartache, and if you want to go one route, you're not going to deal with the other route, and that's the trade-off.
Okay. Anyone else? Staff? Mr. Elman?
Just a real short comment, and I'm not advocating in favor of either methodology, but I just wanted you to aware, Cambridge and Associates, who is the leading consultant to, the vast majority of the endowments in the United States, the university endowments, they just came out with a paper yesterday advocating this strategy. So we're very much, in surfing terms, California terms, we're at the very front edge of the wave, toes over the board. I wouldn't be surprised if in 5-6 years we actually find that a good percentage of the industry is using this. So it's not uncomfortable. It's not unusual or surprising that we feel a bit uncomfortable because there really isn't anybody to look around. But I want to applaud the board for letting us go through this exercise. PCA has done some excellent work, I think groundbreaking work, and I think at some point, I've encouraged Neil and Alan to publish this. I think they could win some awards. And people will, I still think, 10 years look back and recognize, wow, they were actually way ahead of their time by looking at this. So I want to thank everybody for going through this. And as Alan said, we'll set up the April agenda and get down to the nitty-gritty.
Thank you for that. Before you leave, we're going to let Mr. Reyes have the last word.
Not that we want to follow suit of what our friends across the river are doing, but are they doing something in this area?
Yes, they are doing something very similar, and we're involved across the street also. But in this case, I would argue, a good 6 months to a year in front of them.
Again, not that we're going to follow suit, just for my own edification. Thank you.
Do you want to comment, Chris?
Yeah, I'm gonna,
You have to.
respectfully disagree. Now, Alan's a consultant, and I'm not over there, but, okay. I think we're light years ahead, but that's okay.
Okay, so with that, we thank you for the item. Look forward to the next step in the process in April. This is a time check.
They don't pay me.
Why don't we,
They run my retirement account.